Hey everybody, welcome back to Ryan Makes Sense, where we talk personal finance, investing, and chart analysis. Today we're going to be looking at real estate, which is a key contributor to growing your assets, net worth, and also potentially creating a stream of income from rental property or properties. In today's video, we're going to look at 5 periods of real estate downturns. We're going to look at a Fred data chart that shows us the dips of these exact periods of downturns. We'll look at Thinkorswim as well to basically look at a chart, my kind of bread and butter, to see if we can find a potential pattern we can chart or find some type of support in terms of having realistic housing prices and where we could potentially see, some relief when it comes to the rising costs of real estate. We'll also look at finally the periods of panic, which accurately predicted all 5 of these housing downturns and may predict the next ones. So without further ado, we're going to go ahead and shrink our heads together and we're going to jump on in. So, significant downturns in the housing market. Numero uno, the 1930s Great Depression. 1929, October 28th, 1929, there was Black Monday, where the Dow Jones fell 13%. That following Tuesday, it fell 12%. And by mid November, the Dow had lost 50% of its value. Fast forward a couple months, that brings us into the 1930s, the Great Depression. So the Great Depression between 1928 and 1933, housing prices declined by 25.9%, including an annual dip of 10.5% in 1932. However, within the ashes comes a phoenix, right? Outside of that event, the FHA loan, if you're familiar, the FHA, the Federal Housing Administration that insures mortgages, was created in 1934. There was also a Federal Savings and Loan Insurance Corporation that did insure the savings and loans. However, that did lead to another crisis down the road that we will get into. But our first period, 1930. Period numero dos, stagflation, 1970s. So, this 1970s kind of reminds me of what we're experiencing in 2024. High inflation, stagnant economic growth, fluctuations and declines in housing prices, depending on where you live. Look at Florida, what's going on there. They're instituting the new HOA property rules where you have to have certain percentage of funds in the event of any catastrophic damages. All backdated work that has been put off needs to be completed. So this is just along with people who got into Airbnbs and wanted to do that, have rental properties in Florida. So we're seeing that in Florida. But if you're looking at places like Oregon, Portland, Oregon, Hillsboro, Oregon, Beaverton, Oregon, the metro part of outside of Portland, Oregon, that's been extremely strong. Looking at Summerlin, Nevada, extremely strong. So it's not a one size fits all type of event. We're just seeing different fluctuations, different periods, different areas of the US. During the 1970s, real estate tripled in California, which is absolutely incredible. California to date is still extremely expensive. So if you did buy in the 70s and you still have real estate, kudos to you. And also, additionally, in the 70s, the United States did leave the gold standard. So a lot of activity in the 1970s. That brings us to our period numero tres, the 1980s recession. Again, high interest rates, a slowdown in the housing market. You may or may not know, depending on your breadth and knowledge of the real estate market, former Fed chairs. So, Fed Chair Paul Volcker, if you've heard of him, he is one of the Fed chairs that raised rates to 18% in 81. Absolutely stunning. Additionally, the amount of debt on commercial properties tripled from 1980 to 89. That leads to new space that is unoccupied, there's an oversupply, people losing money. So, and then kind of following up on our 1970s California boom. In 1984, that boom had ended, where buyers disappeared and properties stayed on the market for months or years. Number four. Number four. 1990. So remember all these dates: 1930, 1970, 1980, 1990, and then we have one more. I bet you can't guess the date. Okay, the 90s recession was caused by the savings and loan crisis, the S&L, which again failed in 1980. Housing prices started their decline and collapsed over 20% before bottoming out in 1996 and took another 4 years to recover. So if you bought a house in Los Angeles in 1990, you had to wait 10 years until you got back to neutral ground, above water, or flat. Additionally, wages were going up. Values across LA doubled from 84 to 90. However, like we just said, from 90, you had to wait till 2000 to get that same value that you purchased. So again, 1990 was period number four. And lastly, the 2008 Great Financial Crisis, the GFC. Probably the biggest crisis ever, due to subprime mortgages. If you've ever seen The Big Short, or if you have not seen it, I highly recommend you watch that. Essentially, borrowing, lending standards did not exist. You could lie about your income or inflate what you were making. You could over leverage. You could buy multiple properties. It was just absolutely insane. So check out The Big Short. But this did lead to a huge collapse. I'm not going to read all this. You feel free to do all that. People lost their jobs. Lehman Brothers went out of business. Real estate hit an absolute bottom. And again, 2008, between 2008 and 2012, I think were the greatest times to buy. So, and also the total losses were estimated in the trillions globally. So 2008, I should not have been in high school. I should have been buying real estate. So that's on me. But anyway, I moved my head so you can read the other part that I had created. So now that we read all that fun stuff, we're going to take a peek at the Fred chart. And just really quickly, you guys know I like to look at charts, not these kind of charts, but candlestick charts. So what you can do if you go to this Fred website, there is tons of data you can look at. They'll give you a code. Take this code. You can go into Thinkorswim. Just paste it up here. And this is what we're looking at essentially in terms of a Thinkorswim chart. Just wanted to give you that little breadcrumb. So again, we looked at the 1970s, 1980s, and then the 90s. Here's our 2008 Granite Financial Crisis. These shaded gray areas here, here, and the quickest recession ever back in 2020, right before the COVID. So I mean, you can see every time we breached this, and I'm sorry, the hovering, it's picking up, but you see this bar right here at the percent per annum 15, this line that goes all the way across. Every time we breach this, we come back down rather quickly and swiftly. So right here again, end of 70s going into 80s, we breach it again 2005, and then we go down all the way 2008. And then we breached it again in 2022, and you could see we have bounced here Q2 of 2023, and now we're at Q1 of 2024. So when I look at this, I try and in my head gather how can we break this down into how to forecast the future and what we can do, because looking at these kind of line charts don't really help me. So again, I grabbed this code right here, and we're gonna go to Thinkorswim, baby. So Thinkorswim is an absolutely free platform through Schwab now. Used to be TD Ameritrade. So there's several ways we can do it. I mean, I could draw a line down here and basically we can create support where we can see housing has typically bounced off of this line right here, with the exception of 81, 82. Again, we see a nice bounce here, kind of falls under right here. Now, we would have to see some type of crash that we saw in 2008 to get from this peak right here, because this is right here, the 2005 boom, 2000, well, all the way down 2008, 2000, bottoms out in 2012. I just don't think we're going to see a crash like that in a while. I think what they have right now is 2-1 buy downs. You have residential home builders locking in rates at like 4.9, 5.9%, and you keep that through the 30-year fixed loan. So I don't think we're going to see another dip down here like we have before. And there's several different ways we could do this. I think what we could do is go through the midpoint as much as we can between all of these different peaks and troughs. So right here, I'm going right through the middle, going right through the middle, going right through the middle. Here's about the middle. Here's about the middle for 2024. And just trying to stay as realistic as possible. So essentially what I'm talking about is right down here. Oh, good Lord. Right down here, we're right in the middle of that cross section right there. We're about in the middle right here. For this peak and trough, we're actually on the higher end. However, for this peak and trough from 1997 to 2006 to 2012, I think we're relatively roughly in the middle. Apologies, my mouse is going out. I think we're about in the middle there. And then again, for this bubble, I don't know if I'd call it a bubble, but this growth here, it's hard to say if we're in the middle because we haven't really seen our swivel back down. So, and you also got to think the Fed is potentially going to drop rates in September this month. So I think this area right here is going to actually go up. Again, this is residential property prices for the US. Rates go down, housing prices go up. People are going to lose their minds. They're going to want to go out and buy houses. That's kind of what the media has been portraying. So we'll see what happens. But I mean, rates go down, it makes monthly payments more affordable so people can look at potentially purchasing that were on the sideline. So have we peaked here and are we turning back down? Or are we going to keep moving up? And maybe this is the middle and we go up to here. I'm not 100% sure. So obviously this cycle from 2020, I don't think it's completed and is going up, which leads you, sorry, it doesn't make you, which leads you to believe, okay. And then let me just draw one more data point actually, or one more trend line. So we could see here, extend to the right. So potentially we could see some resistance up here and then see a downfall come through here, which would make a lot of sense. And we can see, let's activate this really quick. Oh, geez. Oh, geez. Okay. So what we can see is we're at the peak here. We have resistance, resistance. We broke through up here, but I would consider this being resistance. So in 3 different areas, we've hit resistance with the caveat we did not hit this cycle resistance. So again, if we did hit that cycle, it still just kind of gives us I don't think it really gives us enough data because it goes right through the middle of this cycle here and potentially through the middle of this cycle right there. So we're not going to look at that. We're going to look at our maximum resistances across the different peaks. So again, right up in here, we could see potentially up in here. So we'll come back and we'll review this eventually. But what I want to show you now is the cherry on top of the whipped cream, on top of the pineapple upside down cake that was made with love. The periods of when to make money. Now, let me just explain this to you guys. This is one of my most popular videos on my channel. So period A is the years in which panics have occurred and will occur again. So we've got 1927, right before the 1929 Black Monday. 1945, I believe that was World War II. 65 and 81, I forget. 1999, we had the dot-com bubble. 2019, we had the COVID. B, years of good times, high prices, and the time to sell stocks and values of all kinds. So the A is like the max panic, B is like a good time to sell, C is the years of hard times, low prices, and a good time to buy stocks, corner lots, which is real estate, goods, etc., and hold till the boom, which is A, period A. Good time to unload. So right, if we're trying to delineate and differentiate housing crashes, because when we think about the dot-com bubble, 1929, COVID, we associate that with stocks. But when we think real estate, we think 2008, 1990, 1980, 1970. So in 1930 as well. That was our first one. So this down here. So if you would have bought in 1931, you would want to have sold in 1935, unless you wanted to hold from 1931 up into the next period of panic of 1945, and so on. So looking at the latest great financial crisis, 2008 was almost I guess 2012 was the bottom. Let's go back here. Fact check. 2012 was the bottom. 2012 was the bottom. If you would have bought your real estate in 2005 and sold in 2007, you would have been okay. Again, buying in 2005, selling in 2007, you probably would have lost a little bit of money there. But 2007 is when things got bad. So think about that. Things got bad 2007 and went down and bottomed 2012. 2016, I don't think, let's see, 2016. Yeah, 2016 did well up and ongoing. And so now our next years of good times is going to be 2026, where we go back down into a potential stagflation. Again, not much growth, probably still dealing with inflation, the way the US has given away money to freaking Ukraine, Israel. So potentially 2026 could mirror the way 2007 acted 2012. However, again, we discussed this. There's no real major catalyst that will really lead to this. Buying and lending standards are extremely tight. They have the 2-1 buy downs. Home buyers are offering some lower rates depending on the area. So it really all just depends. I mean, but you would have been safe if you bought in 2000. If you would have bought any of these times in the past and held it, I mean, you're going to do fine. It depends on how long of the mindset you have. If you want to buy real estate to live in it for the rest of your life, or if you want to buy real estate to live in it a couple of years and rent it out, or if you want to buy real estate to fix it and flip it, it really all just depends. But if history repeats itself or rhymes, I'm thinking 2026 to 2032 is when we could see maybe some relief in the real estate arena. But again, if you're going to buy the house to sit on it for a decade plus, you're probably going to be okay. If you're someone who gets really nervous and you are maybe borrowing too much for your income or what you're planning, um, that's where it could make a pretty big difference. So again, a lot of factors go into this. Potentially 2026 is where I think we might see a real estate um, plateau. So, and I think 2026, because they're about to lower interest rates, I think housing prices are going to go up. We'll see a flood of buyers come in. Um, and yeah, I think it's just going to inflate prices more. However, again, if you're a long-term person, you're going to sit in the house for a long time. No big deal. And you're secure with your financial situation. So, anyway, I wanted to share my thoughts with you guys. I'm glad you made it this far. And if you did, please consider liking or subscribing or leaving a comment. The engagement does let YouTube know that I am providing some type of information that maybe should be shared to more people. But I appreciate you for watching. Thank you for spending your time with me. See you later.